go, I mean, of course, the dollar is likely to appreciate against the Indian rupee. So now coming back to our, subject, basically. So if we have, some money in payable, Chandra, I'll just ask this question to you. Are you hearing with me? Are you hearing? Chandra, are you there?
Yes, sir, I'm here, sir.
Suppose you have to pay $1 lakh, okay, to someone in the month of April, okay. So today the rate is about 74 rupees, rupees around, and according to the estimate, suppose it is going to be at 76 rupees, assuming that our imports, widen, the deficit of the import export goes up further, and not much of money is going to come from the FII and FDI. So you think that the dollar is going to touch 76. So what are you going to do basically to protect yourself or hedge yourself? So of course, Chandra, you may not be able to answer. Nikita or Puru or Udit, anyone, can you answer what you're going to do?
So can you repeat the question?
Question is that you have imported $1 lakh worth of goods now, and you are going to make the payment in the month of April, and you expect the dollar to go up by appreciate by another 2 rupees from the current level. Okay, so what you are going to do to protect yourself basically, to hedge yourself? अभी कुछ है आपके पास? हाँ, बताओ निकिता.
We will fix the rate today.
हाँ, तो फिक्स के लिए आप क्या करोगे आप? What you are going to do?
Contract.
We'll go with the currency options. Sorry, futures.
No, of course, I'm just saying that, of course, that will be one. So, अभी आप क्या करोगे? ठीक है, that is good. That you will go into the futures market. Okay, but if you have to have to make a contract, what contract you are going to make? Nikita, you were trying to tell me? If you have to make an OTC contract.
Making contract on the present rate and continue till the 1 year. And also change according to the years, maybe.
No, Nikita is going to tell you what we are going to do. Nikita, what are you going to do in the OTC market? Udit, OTC market में क्या option है आपके पास? Anyone? Puru, Shrey, if you all attended my foreign exchange classes, तो क्या करोगे आप? You are going to enter into a forward contract with a bank. Okay, fine. Chandra, please listen it carefully. You are going to go to the bank and say that, I am going to, make a payment on 1st of April. Suppose it's going to be on 1st of April. So please give me a forward contract so that I can make, 1 lakh. So that you give me $1 lakh. I mean, you let me know what is the rate at which you're going to give me. So the bank gives you a rate of about, say, 75 rupees. Okay, what is the rate today, Chandra? 74.79 or 74.80, isn't it? So you go to the bank,
yes,
and the bank says, okay, we'll give you the dollar at 75 rupees, for example. Okay. So you say, okay, it's only 20 paisa, costlier. So maybe the dollar may go up by 276. That is your, estimate. So you can go to the bank and purchase a forward contract. So bank will say, okay, we'll give you delivery of $1 lakh on 1st of April, and we will charge you 75 rupees per dollar. Okay, so you enter into this contract with the bank. On 1st of April, when you go to the bank and you can take $1 lakh from them and give it to the importer, so you have to pay 75 into 1 lakh, so 75 lakh rupees. Suppose it happens, as a good luck for you, suppose it happens that the dollar moves to 76 as per your prediction. How much money you have saved, Chandra?
So 75 into 1 lakh, right?
So it is so 1 rupee it has gone up. Okay, so 1 rupee change into 1 lakh. So it is 1 lakh rupees. Okay, fine, isn't it? Agar you would have paid at 76, you were not entered into a forward contract. You were paid 76 lakhs, but now you are paying only 75 lakhs. So difference is 1 lakh. So how much you have saved now, Chandra? In terms of rupees?
1 lakh, sir.
1 lakh. Is that clear to you?
Yes, sir.
So, in the OTC market, you can go to the bank and enter into a forward contract. So bank will, make a contract for you. So it will be a customized contract only for you, that you will go to the bank and bank will honor that contract and give you $1 lakh and charge you 75. So that rate is decided today itself on the 2nd of February when you go to the bank. You don't have to pay anything now, but on 1st of April, the bank is going to charge you 75 rupees as against the spot rate of 76, which is prevailing in the market. So bank has already given a promise that they are going to charge 75, so they'll honor it, and they are going to give you $1 lakh at 75 rupees. And had you not taken this contract, you would have been lost about 1 lakh rupees. So this is called an unhedged position. So that means you had two options: to hedge yourself or remain unhedged. So which option was better, hedging or unhedging? Chandra? Sneha?
Hedging, sir.
Hedging was better. Okay, so you hedge yourself. So this is called hedging. Okay, fine.
Sir, what about other case, like if the dollar value goes down?
Now that is a wonderful. Okay, suppose the dollar was at 74. Okay, now in that case, basically, you have actually, lost a lakh of rupees in that case. Okay, because you suppose you should have, not hedged yourself, you would have paid 74 lakhs. But on the date of 1st of April, you are hedging yourself. So, you are paying 1 lakh more. But now there are two issues here. One is that, you won't even look at that because, because your intention was to hedge yourself. Okay, because your own estimate said the dollar will touch 76. But actually, your own projections, came not true and it touched 74. Okay. Now, there is another, kind of way out. Because if you take a forward contract, then it will freeze your money in terms of rupee. You can't take if it goes to 74, that means you're going to lose a lakh of rupees. So the other thing is to take an options. So that is what we are going to study. So if you take an options contract and that is not available with the bank, that for that you have to go to the stock exchange. So that is what we are going to study. If you take an option contract, okay, so in that case it gives you an option to exercise your option. So if the dollar touches 74, you are not going to exercise the option, okay, but you have to pay some kind of a premium. Say for example about 10,000 rupees you have to pay the premium to someone to get that contract for buying the dollar at say 75, but actually the dollar turns to be 74. So in that case you will not exercise your option and you will walk out of the option contract and forfeit your 10,000 premium which you have paid to the stock exchange. But then you are going to buy the dollar at 74 from the open market. Okay. So in that case, what is your gain? What is your what you have saved yourself for?
1 lakh, sir.
You have saved 1 lakh, but 10,000 premium you have paid. So actual saving was only 90,000. Okay, isn't it?
Yes, sir.
So 1,000 premium you lost because of taking a bet on the futures contract, on the options contract. So that gives you basically a contract that in case it crosses 75, then you will exercise your right and you will buy dollars from the options contract. Okay, but in case it comes down, then you are not going to you will leave the option contract and because it's an option. Okay, as I told you one day that if you buy a cinema ticket, and you spend about 500 rupees, but you don't go and watch. So because the movie is so bad, because you got the reviews that it is not even worth spending 3 hours in a cinema hall, but you had bought it. So what you can lose is what? How much you can lose? 500 rupees, because it gives you an option to, but it gives you a right at the same time to watch the movie, but you never exercise your right and you never went to the cinema hall, and the amount which you lost was just the ticket price. Okay, so here also you can take a ticket, which means you can enter into a contract with someone in the stock exchange, which is called the options contract, which gives you a right to buy the dollar at 75, but not an obligation. Okay, which means that you can walk out of the contract. So if the dollar touches at 73, so why are you going to exercise it? Because you got a right to buy the dollar at 75, but the dollar is cheap in the market today. So you're not going to exercise your right, and you're going to just walk out of the contract. So whatever premium you have paid, that will be your loss, but you're going to get a gain of buying the dollar much cheaper on the open market. Is that okay for you? Have you understood, everyone? Any questions, please? Chandra, is it? Chandra, Puru, batao.
Hey sir, I was saying I have understood.
Okay, very good. Chandra, have you understood?
Yes, sir.
Okay, so let's move forward. Okay, fine. So once again, read. Udit, can you read this?
Sure, sir. Forwards and futures. These are financial contracts that obligate the contract's buyers to purchase an asset at a pre-agreed price on a specified future date. Both forwards and futures are essentially the same in their nature.
So basically, as I said, you get you are obligated. You enter into a contract to buy a certain asset, which can be a dollar, which can be a stock or whatever. So you fix a price today, and on a specified future day, you have to buy this asset at the price which you have fixed today. Okay. In futures contract, you can't walk out. It's not like an option, where you can forfeit your right and lose your premium. But here, basically, you have to buy. So it hedges yourself. There is a hedge towards on an upside. So suppose the dollar goes up, then you are paying less. But if the dollar goes down, then you have to pay a more. Okay. So, but at least as a business person, you are. You get a peace of mind that that you have taken a hedge for yourself. Okay. So both forward and futures are essentially same in nature. Okay. So one is the forwards are OTC contracts and futures are traded on the stock exchange. Okay. So that is the only difference, and then we'll understand more about them. Okay. Read further, Udit.
Yes, sir. Sorry, I lost my connection.
Okay. Now I'll ask Chandra to read, please. Chandra, please read now. Bharat.
Yes, sir. However, forwards are more flexible contracts because the parties can customize the underlying commodity as well as the quantity of the commodity and the date of the transaction.
So basically, I told you that, you were going to pay $1 lakh on 1st of April. So the amount is $1 lakh and it is 1st of April and it is between you and the bank. So this is a customized contract on the underlying commodity, which is dollar. Okay. But the same case is not true in case of futures. Just read.
On the other hand, futures and are standardized contracts that are traded on the exchanges.
So basically, futures are standardized. So it is not like, you can cover yourself for 1st of April. Dates are fixed by the stock exchange here. There is an expiry date. Okay, so either you have to wait for the expiry or you can, take a squaring of transactions, and that we'll understand later. But the dates are not, not as flexible as they are in forward contracts. And then you can't go for any amount. It has to be in multiple of, say, $1,000. So the lot size in futures for dollars is $1,000. Okay. So you have to take, so many contracts. So if it is $1,000 and if you have $1 lakh exposure, so 1 lakh divided by 1,000. So that means you have to buy 100 contracts. Okay, fine. So in that case, it's okay. But if your exposure is an odd amount, say 1 lakh $500, so then you can't, fully take a contract for 1 lakh $5,000. So you have to either take 101 contracts or 100 contracts. So either you will be under hedged or not fully hedged yourself. Okay. So these are standard contracts. Okay. We'll understand them more, but we'll be focusing more on the stock market rather than the Forex ones. Okay. Fine. Further.
Yes, sir. Options. Options provide the buyer of the contracts the right, but not the obligation to purchase